All right. Good morning, everybody. TGIF. So we made it to the end of the week. The VIX expiry didn't blow us up. The NVIDIA earnings didn't blow us up. And yeah, we're headed into a short week. Keep that in mind when you're considering options positions. Thanksgiving next week, there'll be reduced time. I think there's an entire day missing, and then there's a half day as well. So it's like it's a it's a short week, right? Not just a day, but a day and a half missing. I was reading through the Fed traffic, lots of talk about how they're trying to normalize things and say that the job situation cooling off the way that it is was mainly just getting it back to how things were pre-pandemic levels, and they can justify it all they want. Still looking at 2% target for 2027. Today is supposed to be relatively quiet, all things considered, sitting in a little bit of a holding pattern. The NASDAQ is flat. The S&P up 0.25%, and that's a little odd. It should get your attention when the S&P is outperforming the NASDAQ. Small caps is outperforming both, and the Dow is leading with its blue chip companies. So you can see we got a lot of Fed speakers. We're really not expecting much. Williams is chipping his teeth right now, but he's not saying anything he hasn't already said before. So we're just looking to get through the end of the day. When we get to the chart, we'll evaluate, what we're going to need for him to sound positive. By the time we're done with lunch, we're pretty much done with data, right? Other than there could be something on the president's schedule, right? Something that comes out of the White House. Let me just check. There's a closed press Oval Office meeting between President Trump and Mayor-elect Mondani from New York. So it's showing as extreme risk based on current schedule. I don't know why that would be such an extreme risk, but whatever. 3 p.m. So that'll be your afternoon risk, is that meeting. All right, we are just above the put wall. We've got some intraday levels, 65.71 and 66.20. Those are both spot gamma levels. Then we got 0 gamma and the volatility trigger, which are a lot farther away, really. We would have to get that 10-week and 3-week and 10-day breakout to be able to get through the volatility trigger. There's just so many levels over our head. So looking at it out on the weekly, we can see examples of these big red weeks and how if it's one and done, the next week usually resides on the inside of the red week, but closes near the top if it's going to be a one and done. This one closed really close to the top. This one was more towards the middle, right? If it's not a one and done, we'll close under the half and maybe even towards the lower edge. So we want to think about next week, which remember, next week is a short week. And that's going to throw off things a little bit. I meant to get some seasonality questions done about how often is the short week for Thanksgiving a bullish or bearish week? And I didn't get it done. Maybe I'll circle back through that over the weekend. But going into next week, how we close next week is going to be really important. We're going to want to close above that mid. If we close below it, and if we close near the low of this week, then that's not going to be very helpful at all. We've been working our way down. Remember, we talked about that pullback yesterday and how if that pullback was going to hold and we were going to continue to go up, then this would have been considered our low. But we stayed inside that range and we broke down. So now we still don't know if this is our low. We're going to need to see price rise up far enough away from this low and hold it that when we look back, we can say, oh, yeah, that's our low. But we don't have that yet, right? What we can say is in the past, when I've seen price do this, there's always that argument between, is this a double bottom or is this an inverse cup and handle? Because an inverse cup and handle is a bearish pattern, and we would want to stay bearish and look for downside moves. But a double bottom is a bear trap, and it's a bullish play, and we would want to look for upside moves. Now, there's no perfect science to this, but the way that I play it is a trap only works if the thing that you're trying to trap actually gets into the trap, right? If a bear just walks up and sees a trap, then you didn't trap a bear. You got to get him in it. So what I want to see, if this is a double bottom bear trap, is I want to see us break the previous low, go lower than that low so that the bears get in and begin to participate. Because remember, what makes it a bear trap and such a beautiful trade is how strongly we rip back the other direction after we trap those bears and rip their heads off. We want them buying back their positions so that they add to the buying that fuels the push that drives us higher really fast. And if we don't get below the previous low, then we didn't trap any bears. Seems simple enough. So how far below the previous low do we need to go? I like 111, 1236 if we need it, but yeah, right? The typical extension that I run in my own little world. my 111 and 1236. So I'm looking for an overshoot 64.92 cog line, 64.50, because remember, we're still running 50s. Getting all the way down into the 1236 would be a little deeper than I want to get, but that is the level of the overshoot that I want to see before we get that reversal. A nice reversal pattern like a Morningstar reversal would be good, but even one of those dragonfly dojis or something like that I would take it, right? Drop base rally pattern, 3-bar swing low. I'm not picky. I'll take any of them. So that's kind of what I'm looking for this to be a double bottom. If we bounce on this level like we're doing right now, and we continue to drive to the upside without getting that extension below that low, this little bitty wick doesn't count, right? That's not enough to trap any bears. So if we bounce here and we go up, that to me is less of a double bottom, and it's more of an inverse cup and handle. And I will be looking for downside moves. How low do we go? 50% of the cup is the first stopping point. All right, so you snap the fib to its highest level. Well, for this, it wouldn't even be a fib, it'd be a quadrant. And you lay in 50% and 100%. $63.32 cog line, then the 200-day moving average, then 61.26. Right, so it doesn't owe us 100% of the move. It only owes us 50%. But the textbooks will tell you if you measure a pattern like a head and shoulders, cup and handle, rising wedge, when you measure those patterns, you have two targets, 50% of the move and then 100% of the move. And if one level is breached, it opens the door for the other level. So that's why we mark them both. But it doesn't owe you the second level. That just becomes your next target. So that's what we're looking for. Simple enough, right? Now, if we do bounce and we start working our way back up, how high should it bounce before we think that it's not a cup and handle and that we're actually just running back up? Same measure. We can just snap that same fib again. We got a line here at the 786. And for me, that's a really good line to use. We're talking about the pullback level, right? So price has rolled over, comes down, it bounces, and it's on its way up. The textbooks will say that the handle can be about 1/3. But to me, that's too deep, right? It always has seemed too deep. But what they're basically saying is that we can overshoot the 786, but fail to get back to the half. So I've got this pattern called a failed bear flag. And in that failed bear flag, we get this part of the move, and then we just kind of chop around at that 786. We can wick above and wick below. We can, we can get down here and a little bit up here, but we never get to the half. And we just do that for a while. And the reason we call it a failed bear flag is we go sideways long enough and we start working our way back up again. And of course, that creates a regular cup instead of an inverse cup. The flag fails to break down and we fail to go lower. So for that pattern to set up, we're going to want to stay inside of yesterday's range and below yesterday's half. Well, we were talking about overshooting the 786, and that's what this half gives us. If we overshoot the 786, how far should we go? 66.70. That's the peak of the handle on the inverse cup and handle that I would expect, right? So we get the inverse cup, there's our handle, The handle shouldn't really rise higher than 66.50, but if it does, we could overshoot into 66.70 and then, roll on over and do that thing. If we stay below the half and we just chop about, then we could build a base down here and end up making a whole new regular cup going the other way. It would negate the double bottom and it would break the inverse cup just by building a base down here. $66.32 cog line is the level that we want to get above. And of course, it's level by level. We got to get above 65.92, and then 6600, 6611, 6632, then 50, then 92, right? It's just the same old levels and levels all the way up. So at least we got a plan. Some of my concerns is if you look at these three moving averages, that's a really beautiful fork pattern, right? Like the dinner table, you sit down, you get a fork in your hand. That fork pattern tells us that the current move, it's not choppy and sloppy like it was back here. It's spread out really nice, these forks. We can get a good continuation in the direction the forks are facing. Well, they're facing that way, right? And no good. So until that starts to change, these are showing that this is a really nice move to the downside. And so far, we don't have anything to suggest it's going to stop. For those to change, we're going to have to jump above the moving averages and turn that 3 up towards the 10. And at this point, I mean, we're not even at the 3, let alone through it and above it. Here is the 3 right there. 66.19 is right, sitting right on top of a options level from spot gamma. This morning, as we're watching price move, keep your eye on reciprocation above and below VWAP. Whatever you've gotten below this morning, look to get it above, because if we run zipper in through the open, then that's the way it's going to run. We got some extreme volume last night, 200,000. We're normally looking at around the mid 50s. So that's a lot, right? Way above our average volume. So there's a little bit of a concern there. We'll see if they're adding any additional hedges today that might account for that trading. Consider the move through the kill zone, and after Europe opened, the 2 o'clock move really didn't amount to anything, and it was almost 4 o'clock when we did get a big move. So that big move that we saw was not the kill zone move. It's also a lot of indecision and violence. What you looking at? My cat's giving me the stink eye. Yeah, they're hedging. It's a little odd to see them hedging and have volume. Usually they sit out and hedge because they're worried about something. And since they're sitting out, the volume is lower and we see that they're hedging. This time they're not sitting out. They're actively participating in the move and they're hedging. We did not make it to the lower ADR. It gave up on that and it started moving to the upside, and we haven't made it to that side either. The inside day breakout failed. pretty much on the 111. I didn't get it set the way that, I normally would, but it's close enough. So that's a 111 rejection on yesterday's price. It's like one of the best plays that I like to trade. I just don't do it at 2 o'clock in the morning or whatever time that is, 5:30. That'd have been a good time to trade it. So now we got to get through our own Globex high. 786 of yesterday. This is the same line we were talking about out there on the daily. That's 786. If we don't get above that, then we can just sit down here and chop and build out a base. If we can get through the 786, we run for the half, get through that, we could challenge yesterday's high. But it's a really big, wide range. And there's a lot of levels overhead to fight with. That's a really big hedge, by the way. Normally, when we look at it, it's sitting in the 20s. And right now it's sitting close to 60. So they're putting a lot of money into it. I've tried to quantify over the years how far away we can get from this weekly floor pivot before we're, quote, too far away. And it's a moving target because every week that sucker moves. It's not steady like a moving average. But we can get farther away from it on the downside than we can the upside. And we can get farther away from it if we continue to do it every week, right? Like if we stretch away to the downside 3% this week, and then 3.5 next week, and then 3.5 the week after that, and then 4 after that. See, we can do that, no problem. We can just keep stretching it and stretching it and stretching it. But if we have not been making moves to the downside and we break the downside and we go down, we can't get too far away before we run into mean reversion issues and we start bouncing back the other direction. This is the farthest we've been away from it this week, but we've been pushing that envelope, right? We pushed it here, and then we got a little deeper here. So we're working our way down. Since we can't quantify that level, when I was going back and measuring the examples that I found, 3.5 to 4% was a pretty common level where we just couldn't seem to get below that and keep it. If we're not even 3% below that weekly pivot, then there's no reason to consider any sort of mean reversion. Now we're almost 4% there. That's enough. 4% in 1 week away from that, that is enough. So for us to go deeper than this today and keep it would be a very rare thing. I'm not saying that it can't happen, because we all know price can do whatever the hell it wants, right? Tell price it can't do something and you'll just be sitting there holding its beer while it shows you it can. But it would be rare to go farther away than 4% and keep it, especially on a Friday like this. And it's going to have to be something really bad, really negative to make that happen. Otherwise, let's get back inside of the channel. Now, this channel that we're looking at is the daily floor pivot channel. It's called CPR, Central Pivot Range. The central pivot is the floor pivot. It's just another name for the same thing. And the range is that channel. So CPR, Central Pivot Range. If you're on TradingView, that's the indicator that you want to look for. Thinkorswim doesn't have the central pivot range. I had to make my own. But whatever, right? So this is the floor pivot. If we can get inside the channel, we can aim for 66.32 cog line. Get through that, we can get through the top of the channel, which is yesterday's pivot point, and we can work our way back up. It's a really wide range. Wide ranges imply that if we break out, it doesn't stick. Well, we did break out and it didn't stick. We came back in. So far, so good. It's also a missed daily pivot, just like yesterday was a missed daily pivot. At least it was until we hit it. So right now, this is a missed pivot. It will be unless or until we hit it. So that's what we're focused on. Now we got to check the S&R levels. Since yesterday was such a big day, it stretched our S&R levels by quite a bit. If we break back down through our own Globex low, breaking that 65.25, then we'll aim for 64.71, which is S1, and then S2, 63.92 cog line. Otherwise, get through the floor pivot, the upper part of the central pivot, then R1, 72.11 cog line. All right, we got a relatively decent distribution on the week, but we still want to consider this a double distribution. So we got that structure across the highs, and then of course right there in the middle, 66, 63 with that point of control. If we make a run to the upside, that's a level that's going to be difficult to get through, on top of all the other difficult levels that are over our head that we have to deal with. We don't have any work showing up down here right now. So that'd be another piece of it, is that we want to see that we actually come down into a bunch of buyers, not just that we ran out of sellers or that sellers got exhausted. Looking back, we don't have any structure down here really. I mean, there's this point of control from way back here, and we tagged it here, but we weren't able to breach it. And now we've tagged it again. We did cut through it, but we got right back above it again. So what we're looking at is the second week in September, it looks like. $65.37, close enough. Maybe 68.38. Oh yeah, I like it. And this one didn't even hit it, so we got close. Close don't count. Hand grenades and horseshoes and marriage. So we hit it this time. We've danced through it multiple times. It's still holding. I don't know, third time's the charm. So I think if we breach it again, we're going to take it. But we don't have anything else back there, right? We'd have to stretch the map out and see what we got. And it's in a completely different expiry, right? The futures expire. We got new contract. It's not really useful to go too deep into an old contract. This week that we're using was close enough to the contract's expiration that it still counts, but I wouldn't want to go any deeper than that. And we can see that it's multiple levels, right? This one, this one, this one, and this one. So all four of those make up this zone. So it's a really big structure. If we break this and we get below say 6511 cog line or the roundy at 6500, then that puts 6450 on the table. I've always argued though is once you're under the 50, you open the door to the next 50. That's just the way it goes. But opening the door and getting owed the level is two different things. Ten-day, 30-minute volume profile in TPO. This is such an ugly mess. Scattered distribution all over the place. There's no real good insight into any of this. We got a high volume node overhead at 6650, which shouldn't be a surprise. It kind of thins out some and then into 6760. Then it thins out some and back again at 6870. So just got to give this one some time, let it clean up, get rid of some of this trash on the back end, and see if we get any real insight out of it at that point. One of the main things about using all these different tools is if there's nothing there, there's just nothing there. Call it the trash that it is, leave it alone, go find something else to look at. We hit that VPOC that was sitting up here, so we're done with that. And we hit this VPOC down here from the 19th, and we're done with that. We got one from yesterday, which we're threatening to hit right now. And if we do hit that, then it wouldn't be a VPOC anymore. The thing is, some days it's worth keeping them on the radar all day. So I'm going to keep that one on there. As long as we're underneath it and we have a chance to interact with it, I'm going to leave it on there. I think we might get some value out of it today. We haven't hit it yet, so technically it still is a VPOC, but even if we do hit it, I'm going to keep it. We got a really clean distribution this morning. It's all piling in across the top here, but that's where we spent the most of our time, and it's where we are back now, right? We're hanging out up there again. The low is not really all that telling, right? We didn't see a bunch of buyers step in down here. It just thins out. So I would have liked to have seen that defended a little better, but I mean, there is a lot of structure right in this zone. What is that, between 65.40 and 65.30? So that 10-point range, they really came in and put in some work. I guess that's as good as we can hope for. We've got a projection of next week's range. Remember that next week is a short week, and this indicator does silly things when it comes to short weeks. Sometimes it works okay, sometimes it does not. That's why it's always better to draw them by hand. But I get it. If you're running equities, and there's so many equities, you wouldn't want to spend all weekend trying to draw the lines on all of those equities that you want to look at. But as a futures trader, if you're trading 2 or 3 things, then you could mark out 2 or 3 things, right? Look how big next week's range is compared to our week's range. And next week is missing a day and a half. There's different components that go into the math that makes this range. One is the square root of time. How many days do we have? And the other is volatility. Well, if next week has less days than this week, we don't have the capacity to travel as far, right? If I get to drive for 5 hours and you only get to drive for 3.5 hours, who do you think can drive farther? Me, because I got 5 hours to drive and you've only got 3.5. So next week's range by default should be less than this week's range simply because it has less days. Then there's the volatility aspect. If next week has a known unknown, CPI, PPI, non-farm payrolls, something like that, then it would be a volatility suppressing event, and the range would be narrower because we have that volatility being suppressed. That's not what we got. We got less days and a wider range, which means there's a lot of volatility being priced into next week. Not the lack of volatility, but the increase in volatility, a significant increase. And it's hard to quantify how significant it is because we don't have matching days. If next week was 5 days and this week was 5 days and the range was that big, we would know that it was all because of volatility, and it would be, just X amount. There's so much volatility being priced in next week that it covered a day and a half of missing price action and added the additional range on top of it. That's a significant amount of volatility. Now, again, that indicator can do silly things on a half week. If you want to do it yourself, here's the problem. We're using a static expected move range. We don't want one that is moving, right? We don't want the dynamic. We want the static. So you want the one that says 7 days to expiration, and you only want to use it after the market is closed and everything stops moving. So 4:15, 4:30, whatever it is on Friday, I usually just catch it on Saturday or Sunday. I don't even mess with it on Friday. But if you sit and wait until after that. So you want that number when it's not moving, and that's one side of it. We can go up 190, we can go down 190, and that's what you would mark out. But don't start marking anything until after the close and after everything stops moving. If you do it on Sunday, make sure you do it early enough in the day that you don't run into the Sunday open, right? Because if it's within an hour of the open, it's going to start moving again, and then you missed your mark. So you got to catch it after hours on Friday, and then before on Monday, or before on Sunday. That didn't look extremely large, by the way. $192 has basically 200. So 65.83, 66.83, 67.83. Yeah, this is actually a little short at the moment. We'll see what it looks like on Monday, I suppose. We'll just leave that drawing here. And remember, now through the day today, this range is going to expand and contract, and we'll have to reevaluate it on Monday. But so far, the projections is that next week has a whole lot of volatility being priced into it, and it's a short week, so that's a lot of volatility. And it's not because of a known unknown, right? If it was something like CPI, PPI, non-farm payroll, those are volatility suppressing. It wouldn't widen because of those events. It would shrink because of those events. So it's not that. It's something else. All right, we are below the 10-week, around 1.4%. We've been talking about getting down below that 10-week for a while now. We haven't been down there since we ripped back out of it after the April lows. If this is the reset that we're looking for, then this should be one and done. But as you can see, now that we're below it, we could stay below it for a while. And that's the trouble that we're facing. We don't know what it's going to turn into yet, but with the forks looking as good as they do, and now that we're below the 10, if we keep that, we could expand below it quite a bit. The typical expansion is somewhere around 4% underneath the 10. That's not too far below our current level. We're just looking at another 4% to the downside. The problem is the 10 moves with us. So it's not just 4%. We got to go farther than 4% so that once the 10 does move, then we're at 4%. We're looking, right now though, I'm expecting maybe a one and done. Let's see what happens at that point. You can see these one-offs where we get below the 10 and we come right back up again and they don't last long. The ones that lasted a while typically connected to some sort of situation or event. And we don't have a situation or event at the moment, right? We kind of got the lack of. All right, looking at things that are down this morning, the benchmark I use is 0.5%. Got uranium, China, Mag 7 down, volume is down. Yes, that's a double negative. And Bitcoin is down, still bleeding like a dog. Yeah, not really though. Bitcoin is down over a 5-day period, about eight and a quarter, 8.5 ish, right around in there. I mean, that's not that bad. Not for Bitcoin. It just compounds, right? Because it's been down and been down and been down. Been down? Down. Lots of stuff on support. All right, so looking at what's up this morning, same thing, benchmark 0.5%. We got the Mag 7, banks, XRT, consumer discretionary banks again. So financials and Mag 7 and consumer discretionary are exactly the three that we need. The thing is, I don't think that's going to get it by itself. Now we got chips moving in the right direction, but they're not there yet. And I kind of like that they're not there yet. If we put all the work in the pre-market, we're not going to have any work left in the regular session, right? So holding back, keeping it in reserve until the bell rings and then coming for it, I like that a little bit better. Now SMH is still down over 5.75 over a 5-day period. So this little bounce to the upside could just be because we fell 6%, right? Can't really argue against that. So when we start moving this morning to the upside behind all of these sectors, we want to see that it's fanning out, right? The rising tide that lifts all boats. We want to see that we don't get a rally day simply off of the Mag 7 and 0-day options flows. If that's what we get, I guess is fine, right? But they're harder to detect if it's so narrowly concentrated, or maybe it's just harder to trust when it's so narrowly concentrated. We'll just sum this up nice and easy. As always, GTFO, right? Get out of this box before you do anything else. If you get out of this box to the upside, you're still inside of this box. So you just changed one for the other. The thing about trading inside of yesterday's range is always a little stumpy when you're dealing with something like this. Typically, yesterday's range is narrow. And so if you're sitting inside of it, you don't really have a really good trading opportunity because you're just stuck inside of the previous narrow day range. But when you have yesterday's range as big as this, then we don't have that argument. So we could still see some decent price action, even though we are inside of yesterday's range. But I'm still going to argue it won't be decent if we're still inside the Globex range, right? If this is all we have to trade and this is where we stay today, it's not going to be very pretty. got to get out of that box before we do anything else. So an upside breakout, we got yesterday's mid and then yesterday's high. Even on that breakout that we're talking about, you could even run, you know, the 111 and the 1236, even off of just that. Then you got yesterday's mid. I didn't catch that perfect, but you get the idea. So we'll run the 111, 1236, catch OCC and move the levels again, and it'll probably catch us up to that level, on and on, right? All the way back up. The other direction, though, if we break to the downside, then we've already run yesterday's 111. We'll want to run our 111s off of the Globex and extend it to the downside, and then OCC on to the next level and move it in the next level and move it. 6,500, 6,450, and if we overshoot 6,450, then we got 6,400. I really like 6,450 at this point if we continue the move to the downside, because it would line up well with that inverse cup and handle that we were talking about, right? 64.42. You know, 42 is an old cog line that we don't use anymore, but 64.50 is just above it. Get an overshoot of 64.50 into 64.42. I like it. So if we get ugly, that's where we're going, right? That's the coyote ugly level for the day. Otherwise, let's try to get through yesterday's midpoint and get back into yesterday's wick structure. That wick structure is all the way up here. Tangles us up into the moving averages. If we could get up there and stall for the day, that'd be a good place to go into the close. Trying to line it out for next week, I think it would be better if we stayed near these lows for the day, closed somewhere down here, nice and easy, gapped down deep in on Monday, you know, like below 64.50, gap down into like 6,400, and then just do this face ripper to the upside, trapping the bears and screaming it all the way back up into like 6,800. That's what I'd like to see, but I don't know. I'm not driving, so, you know, we'll get what we get. Everybody, be careful, be safe, keep your eye on the clock today. Have a good weekend. I'll see y'all next week.